Hello and welcome to this week's edition of Tax in 10 with me, Andrew Robbins, and Rachel de Souza. We're both tax partners in RSM's London office and have a wealth of experience dealing with a wide range of private client matters. As we've mentioned before, your feedback is valuable to us, so do please keep it going, especially if you've got any thoughts about topics you'd like us to cover. You can email us on andrew.robbins@rsmuk.com or rachel.d'souza@rsmuk.com. There's been a lot of speculation in the media recently about the possibility that pension tax relief will be reduced. So we thought this might be a subject worth having a look at this week. Rachel.
That's right, Andrew. There has indeed been a lot of commentary. And one of the things that's been suggested is that the Chancellor will to raise some funds by restricting the amount of pension relief that is available. This could be, for example, by having a flat rate of relief at 25%. And it's been suggested, although I've seen wide-ranging reports, that this could save between 4 billion on the one hand and somewhere between 10 billion on the other, but that's according to reports in the media. Anyway, given that this is another hot topic, we thought we would have a look at this and see what it means in practice. But I think before we get into it, I'm going to start with a brief explanation of how pension relief actually works. So very simply, if you are a basic rate taxpayer, and let's say you make a contribution of £80 to your pension plan, the government tops this up and pays £20 directly into the pension plan. The total amount of the pension contribution for that basic rate taxpayer is £100. Alternatively, if you pay tax at 40%, again, let's say you pay £80 into your pension plan, and in the same way, the government tops it up to £100 by putting £20 in directly. But on top of that, you as the individual can claim another £20 back from the government as a tax-free payment. So the pension contribution remains at £100, same as the basic rate taxpayer, but has actually cost you £60 because you only put in 80 and you've reclaimed 20.
Yeah.
Once the money is actually in the pension fund, it grows tax-free. And in most situations, the value of the pension fund is also outside the individual's estate for inheritance tax purposes on death. In return, the deal is that when you come to take income out of the pension fund, it is taxed at income at your marginal rate at that time. Although at the moment we have a 25% tax-free amount that can be removed from the pension plan up to the value of the lifetime allowance.
So what I'm hearing is this all sounds incredibly generous, especially for higher rate taxpayers. I'm getting my 40% pension release, so my £100 actually only costs me 60. I'm getting tax-free roll-up of the money while it's invested for, who knows, 20, 30, whatever years. And then a quarter of it potentially comes out tax-free into my hands at the end of it. I mean, when you put it like that, it's no surprise that the Chancellor is looking to stop what would seem to be a massive giveaway to the wealthiest taxpayers. But I assume there must be some reason why these rules exist in the first place, because otherwise it just looks like robbing the poor to pay the rich.
I think it all goes back to the fact that, I mean, it's a non-tax reason why we have pensions and why successive governments, and I think it's also worth mentioning that's not just here in the UK, but in the majority of other countries, want to encourage taxpayers to save funds for their retirement so that when they get to that retirement age and they're not actually earning any money, they don't become a financial burden on the state and can draw on the pension funds that they have been contributing to throughout their earning years when they're old and decrepit, like we will all become. So that point leads us neatly on to look at what the position will be if pension relief is restricted to 25%, as has been suggested. And it goes back to looking at those calculations we talked about at the front, because the easy answer is that it will have no effect on basic rate taxpayers because you receive relief at 20% in any event. And it's only going to affect the higher paid. If you're not going to get all of your tax relief up front for a higher rate taxpayer, pensions could therefore become less attractive because there is effectively a double tax effect.
So I get the fact that if you're a basic rate taxpayer, you don't care if relief is restricted to 25%. But what's the double tax effect?
So if the relief is restricted to 25%, I may have to then make my pension contributions out of taxed earnings, so money that's already been taxed. And when I come to take the money out as pension income when I've retired, it's taxed again. So I end up suffering income tax twice on the same amount of money. Effectively, therefore, I would need a huge amount of investment growth within the pension plan to compensate for that double tax effect.
Right. So if most of my income is taxed at basic rate and a little bit is taxed at 40%, I'm probably not going to be too bothered by that. But if I'm a higher rate taxpayer and the whole of my pension contribution would have come out of earnings being taxed at 40 or 45%, what you're telling me is it's actually going to cost me a lot more in the future to make those, in cash terms, make those pension contributions than it does today. Gotcha.
Yep.
And I guess if that is what happens, inevitably what we're going to see is a reduction in the amount of pension contributions being made by higher rate taxpayers. Ironically, I don't think the government, in terms of tax, would care about that, because it doesn't matter whether the contributions are paid or not. If the amount of relief being given is lower, it's lower either way. I guess also this means that people are going to be looking at alternative investment approaches. Payments to ISAs are already obviously really attractive. And if people have got enough money to be making higher levels of pension contributions, they're probably already making their contributions into their ISAs each year. But maybe we will also see more investments going into structures like offshore bonds, which I think is a topic for another day, but also things as well, VCTs and EIS, where you will still get some upfront tax credit. The real danger, it seems to me, from a long-term sort of social strategy that you were talking about, is that what will actually happen is that I'm just going to take my contributions, I'm going to spend it all on wine, women and song.
I think it is worth saying, though, that the reduction in the pension relief is not a foregone conclusion. The administrative hurdles of implementing a different tax relief system are huge, and government sources have suggested it could take 3 years to make the necessary changes. So whilst there may be some impetus to get in as much pension contributions as you can, maybe anything that the Chancellor announces cannot take effect for some time, simply just due to the administration that will need to take place.
So this may not be one of those things where you need to act immediately or lose all prospects. It's a more of a watch this space.
So now we know all about pensions and pension reliefs. Have you got something that's keeping you amused this week?
I've gone mainstream this week. I want to talk about, I'm sure somebody you will be very familiar with, singer-songwriter called Agnes Obel. I'm sure you're already aware of this, but she's a Danish songwriter, composer, singer who works out of Berlin, and she just produces the most gorgeous music. It's the sort of thing that makes your hair stand on end when you hear it. It's just beautiful. Lots of piano, lots of cello, and a very clear soprano voice. Very delicate sounding, a little bit melancholy, but absolutely beautiful. Citizen of Glass, I would recommend as a good starting point, but basically anything of hers, you can't go wrong. Agnes Obel, and she's really gorgeous.
Okay, well, thanks for that. Yeah, I don't think I can be doing with melancholy at the moment. I think something a bit more upbeat would be more up my street. Anyway, thank you all for listening. Please let us have your comments and feedbacks. As before, we can be contacted on rachel.d'Souza@rsmuk.com or andrew.robbins@rsmuk.com. We'll see you next time.
Thanks
Bye for
all.
now.